Today, we are diving deep into the absolute explosion of digital banking in Indonesia. We're going to pull back the curtain and look at the raw economic forces that are reshaping how literally trillions of rupiah are moving around. Let's get right into it.
So, to get a sense of the scale we're talking about, just look at this number. In 2023, the total value of digital banking transactions in Indonesia was almost 58,500 trillion rupiah. I mean, just let that sink in for a second. It's an insane number, and it grew over 13% in just 1 year. But, what happens when we go from that massive, nationwide view down to a single player in the game?
Well, this happens. This is the volume from just one platform. One, Bank BRI's corporate system, QLola. That's nearly 6,000 trillion rupiah. So how is that even possible? How does one platform handle that kind of volume? To really get it, we've got to go back to basics, to the engine of any market, supply and demand.
All right, so the whole digital revolution didn't just, add a cool new feature to banking. No, it completely rewired the whole system. It changed the fundamental rules of supply and demand for financial services. Let's break down exactly how that works.
Okay, first, let's talk demand. Think about it. As more and more businesses in Indonesia move online, digital services, things like paying suppliers, running payroll, managing cash, they stop being nice-to-haves and become absolutely essential. So what happens is the entire demand curve literally shifts to the right. More businesses need more of these services, no matter the price. Now for the other side of the coin, supply. Thanks to technology, banks can basically build these incredible automated platforms. This makes the cost of handling one extra transaction tiny, almost zero. This means they can offer way more services way more efficiently, and just like with demand, this pushes the entire supply curve out to the right. And here's where the magic happens. When you get both demand and supply rocketing outwards at the same time, you get a totally new equilibrium point for the market. And the biggest change isn't always the price, it's the sheer quantity. The market just explodes with a mind-bogglingly higher volume of transactions. So this brings up a really interesting puzzle. If demand is surging like this, basic economics would tell you that prices, in this case transaction fees, should be going through the roof. But they're not. So why not? The answer lies in a super important economic idea called elasticity. Let's tackle this head-on. It really all comes down to a simple question. How much choice do customers actually have? And what's fascinating is that the answer is completely different depending on whether you're looking at the short term or the long term.
Okay, this is so cool. In the short run, a company is pretty much locked in. Imagine trying to rip out your entire accounting system that's deeply connected to your bank. It's a nightmare. That means your demand is inelastic. You'll put up with price hikes because switching is just too painful. But give it a few years, and the whole story flips. New fintech companies pop up, creating options. Systems start talking to each other better. Suddenly, you have choices. Your demand becomes elastic, which gives you, the customer, way more power and keeps a lid on how high those fees can go.
So, if the banks can't just keep raising prices forever, the whole game changes. It stops being about who can charge the most and starts being about who can dominate the entire market. To understand that, we need to look at the competitive landscape.
And what we find is a classic oligopoly. That's the textbook term for a market that's run by just a handful of huge companies, like BRI, Mandiri, and BCA. It's kind of an exclusive club. And the big question is, what keeps new members from joining?
The answer? These massive walls, what economists call barriers to entry. And these walls are high. First, you need to get past the gatekeepers, strict licenses from regulators. Then, you need mountains of cash for technology and cybersecurity. And maybe most importantly, you have to build trust, which takes years. All of this makes it incredibly tough for any newcomer to challenge the giants.
Okay, so we've mapped out the battlefield. Now let's zoom in on one of the generals and see how they operate. If we look at Bank BRI again, we can see their entire strategy is basically dictated by their costs.
So here's the playbook for any digital giant. You have these enormous upfront fixed costs. Building the platform, the security, the compliance, it costs a fortune. But, and this is the crucial part, once that's all built, the cost of handling one more transaction, the marginal cost, is practically nothing. It's pennies.
And that leads us to a golden rule in economics. You maximize your profit when your marginal revenue equals your marginal cost. So if it only costs you a few cents to process the next transaction, you don't make your money by charging a high fee. No way. You make your money by getting a colossal, astronomical volume of transactions. It's a game of scale. And this graph shows exactly why that works.
As a bank like BRI gets more and more users, its average cost per transaction just plummets. Why? Because those huge fixed costs are getting spread out over millions, even billions of transactions. This is the awesome power of economies of scale, and it's why their whole strategy is about building one massive interconnected ecosystem of users.
So this strategy has obviously been a huge win for the banks. But what about the rest of us? What are the ripple effects across the entire economy? Let's take a step back and look at who wins and what the hidden trade-offs might be.
First off, businesses are winning. Big time. They get these amazing, super efficient services that save them a ton of time and money. In economics, we call this extra value they receive consumer surplus. It's the gap between what they would have been willing to pay and what they actually pay. And digital banking has made that gap huge.
And of course, the banks are winning. That's what we call producer surplus. It's their profit. Thanks to that incredible scale, they can process transactions for next to nothing and capture massive value. It's a highly, highly profitable model for them.
So businesses win, banks win. Sounds like a perfect story, right? A total win-win. Well, in economics, it's rarely that simple. We have to ask a tougher question. Is this really the best possible result for society as a whole?
And this is where we find the hidden cost. Because we're in an oligopoly, that exclusive club, prices are still higher than they would be in a perfectly competitive market. And that higher price means some smaller businesses who would have benefited from the service are priced out. They can't afford to play. That value that could have been created but wasn't has a name: deadweight loss. It's a loss to the entire economy. It's inefficiency. So ultimately, it's a balancing act. This digital transformation is an incredible engine for efficiency, but to make sure that the benefits are spread as widely as possible and that deadweight loss is kept to a minimum, you need smart regulation that encourages innovation while also making sure the game is competitive and fair.
And that leaves us with one final big question. We've just seen how this wave of technology created a whole new economic reality. Now, with the next wave, things like AI about to hit, who's going to win this time? Will the giants just get bigger and more powerful? Will some tiny, unknown innovator come and flip the whole table? Or will the customers, in the end, capture most of the value? The next chapter is about to be written.